But I would like to invite the panelists for the panel discussion ahead. So firstly, I would like to invite Mr. Chetan Naik. He's currently a fund manager with the venture capital and private equity division of IIFL Asset. And for the moderator of this panel discussion, I would like to invite Sindhu Kashyap. She's an associate editor with YourStory Media. So without further ado, I would like the panelists to take this discussion forward. Thank you so much, Chetan sir. Thank you so much, Sindhu ma'am, for being here. And you can start with the panel discussion. Thank you.
Thanks, Samar. Thank you for that introduction. Hello, Chetan. Good afternoon. I think we have a tough job because our conversation is just immediately after lunch. And those are the most tough conversations, and we don't have an easy topic. We have tech IPOs as a topic, but without further, wasting our time further, Chetan is the executive vice president and fund manager, IIFL. Asset management, and has over 12 years of experience across private equity and investment banking. So I don't think so there's a better person to have a conversation on tech IPOs than with you, Chetan. So thank you so much for talking to us today. I want to get a sense of, how the tech IPOs have fared so far when it comes to pre and post IPO valuation. And if you have any sectoral views, what do you think it would look like in the next 5 years?
Yeah. No, so Sindhu, clearly, if you look at the entire listed tech space, right, markets are really rewarding companies which are going to have sustainable business models. And at IIFL AMC, we have the largest thematic tech-only fund, where typically we invest in companies which are probably 2 to 4 years away from the IPO. The thesis is that some of the companies we are investing in eventually are going to have a very good IPO because they have those characteristics which eventually the listed markets would reward some of these companies in a far better fashion. So, and that's what we're seeing in the markets. There are business models where there's sustainability of unit economics. There's a part to profitability. There are businesses which will not need multiple rounds of financing. Those are the kind of companies have still done well, have fared well in the entire IPO market. Probably the good way to look at this would be what was the QIB pricing, the main book pricing, and post that how the companies have done. Because one way to look at it is that they went to pretty high levels and then they've corrected. But still the way to look at it is that what was the pricing at which some of these companies came when they hit the IPO markets. So there are quite a few which have done still well. They're still doing well. But having said that, there's also a clear indication that some of those IPOs were very, very richly priced, right? And markets have their own ways of eventually correcting the price of the stocks. And in this current environment, markets are going to be volatile, especially with Fed rates going up, especially given that these are high beta stocks and they're highly sensitive to the overall back. And in that scenario, you're going to see some of these companies eventually being volatile in this entire current market. But having said that, if you go back to the US markets for the last 2 decades, there are an umpteen number of examples of how some of the stocks are so volatile. But over a period of time, they have been able to create massive value creation. And that is something which really excites us about the entire tech opportunity. And we believe that if you pick the right assets, that there could be multi-baggers you could actually pick in. And especially for us, since we come in slightly ahead of the IPO when the stocks are not fully priced, and when we are able to pick in some good assets at good valuations. So I think so also in case of tech, a lot of the value has shifted from the listed space to the unlisted space because these companies have seen multiple rounds of financing in the unlisted space. So in a way, the value creation has been significant, but probably the capture of the value has been more in the unlisted space that we haven't seen currently in the listed space. But once this company is correct and they get the right valuation benchmarks, there would be over a period of time, there will be companies which should do well. Not necessarily every asset will do well, but quite a few of them which are very unique business models, They're either placed in some of those characteristics where the inherent models are either tending to be a monopoly or a duopoly. So these companies are going to have a long run, and they should do well.
On that note, I just wanted to understand, how do you evaluate the pre-IPO startups? And I'm sure there are several others this year also lined up to come. Rohan also was mentioning that in his PPT. So how do you look at the evaluation in that sense?
Yeah. So we have done almost 20 investments in the entire late stage tech space. So broadly, we are not much of a pre-IPO fund. We are more of a late stage tech fund. So basically, if you were to break this entire late stage tech across multiple stages, you have late stage, you have mature late stage, you have pre-IPO, right? So anything like, let's say, some of our industry companies like RedSeer or Upgrad will be more of late stage. And mature late stage will be companies like probably Pine Labs when we invest in the company. And pre-IPO will be companies like, let's say, Policy Bazaar when we keep in that asset. So broadly, we have done several deals in the entire late stage and the mature late stage bucket. So coming back to your question about how do we look at some of these companies and what really excites, broadly we have three themes. We are very strong believers of this entire platforms or marketplace. Theme one is that we like winner takes all plays. And again, there are some nuances within winner takes all, but we can elaborate as we go along, where we tend to back some of these companies, especially companies like Policy Bazaar, which has a disproportionate market share in insurtech space, or the food delivery space, which is a equal market share duopoly, and they have seen a fair bit of consolidation. That is theme one, which we like, winner takes all plays. And these companies probably might still have a decent amount of burn going forward. But given the dynamics of the space, given that these companies tend to have winners, we still believe in this kind of business models. The second theme is largely vertical leaders either in e-commerce or in B2B commerce. And this theme typically, we tend to back companies where the unit economics are inherently very strong, right? And typically we look for businesses where they are capital efficient and they have a very strong path to profitability. They might not still be profitable, but the unit economics in terms of the gross margins or the contribution margins are a fair indicator. But if you go and deep dive in this space, there are several companies which are already profitable in this entire vertical e-commerce. For example, if you look at Nike, right? It's a fantastic play in the entire personal care segment, the beauty and personal care segment with 30% kind of market share. Or again, if you look at something like Licious, it's a dominant player in a very large TAM of almost $44 billion. And within that, this is a space which is ripe for disruption, given that there's a lot of value add which are direct to home meat brand can bring in. And again, something like Home Lane, which is a very differentiated play in this entire home interior segment. And the third thing which we like is companies which have very differentiated tech. The underlying tech is so differentiated that they don't have any competition at all. So something like Zetwork, if you look at Zetwork, is the only a meaningful play in the entire large space of tech-enabled contract manufacturing. It's almost a $50 billion kind of space. Also, look at something like Pine Labs. It's the largest player in this entire POS business, and they have almost 60% market share of the enterprise POS terminals. Again, if you look at some other companies like, let's say, Daily Hunt, which is again has great unit economics and is largely a very strong content aggregator play. So in a way, we have defined themes which we believe eventually the public markets are going to reward them, because underlying dynamics are such that the dominant players are going to emerge in each of these platforms of themes, the three themes which I mentioned. And added to that, we believe in three criteria, and we are very, very persistent about that. We like the multi-decadal growth stories. We are backing companies which are hyper growth, and they're going to have a very long tenure of growth, not just this decade, but next decade as well. Companies like the ones which I mentioned. But beyond that, what I really like is that we prefer to play in segments where the overall competitive intensity is low. And the inherent, we focus a lot on the quality of revenues and the unit economics. The quality of revenues is an indicator of how the business is going to do over the next 5 to 8 years. Yeah, there are several companies in our portfolio where the cohorts and the LTV CAC ratios really stand out. And that's an indicator about the kind of affinity this kind of brands are building with their customers. For example, something like Country Delight, where we invested, it has almost 60% or 12 months revenue retention. And this is unheard of, right? And the LTV CACs are almost like closer to 5 to 6x. And a lot of these players are also full stack plays where they're able to control the entire end-to-end value chain. And because of being full stack, they're able to bring in disproportionate amount of efficiencies. So broadly, there are multiple themes, but we tend to stay away from businesses where the business model is still not emerged. We stayed away from the entire payment segment where we felt that UPI has been a great disruptor, and we're not really sure about how the economics are going to pan out in the future. At the same time, we like businesses where there's a clear path to profitability. And these are the companies eventually listed markets are going to reward. So in a nutshell, that's how we look at building a framework while we invest into some of those tech companies in the unlisted space.
I'm on mute. Yeah. I'm fine. I think Zoom conversations and fireside chats on Zoom is all about muting and unmuting yourself. But, you know, you did touch upon the different sectors and the different kind of companies that you're looking at. But building on that, I just want to understand, what does it take for a company to go IPO? Like, you know, what are the timelines like? What are the governance things? And as a late stage investor, you might have a basic idea of, you know, the steps it takes towards reaching the next goal, so to speak. What does it take for an organization?
Yeah. Typically, so there are a bunch of companies in our portfolio which are going for an IPO, and most of them have already turned profitable. So our preference is that when we're hitting the listed markets, we control volatility of the earnings. I think in the unlisted space, the companies can experiment a lot, but as they're coming closer to the IPO, they should have emerged as a brand, and added to that, the overall business should definitely be just about breaking even, or they should be already profitable. So, and that's when we actually urge our companies to go for an IPO. So we avoid if the company is still a few years away from profitability. We generally urge our companies that probably it's good that we ensure that the overall business has scaled up, is showing good growth, but at the same time, the underlying profitability is something very important. And so if you look at almost 40% of our portfolio companies are already profitable. And again, there we have shown a lot of discipline in terms of backing companies, which have shown much higher financial discipline. We are okay even if they're number 2 player in the segment, but what matters is that are they creating more value for the capital they have raised? Like for example, Nykaa was built on just $70 million of financing, right? So go back and look at Policy Bazaar, even the amount of financing they have raised is not that high because they're sitting with a large amount of cash. Again, there are a bunch of other companies like Home Lane and all, highly capital efficient models. They're showing the path to profitability. They focus more on the NPS scores of the customers. And again, those are very important parameters about how are the retention metrics, how are the customers, have they taken care, ensured that the entire operational focus has been well taken care of. There are no snacks in the business models, no snacks in the supply chain. And when that happens, when the companies are just about to hit profitability, and when the inherent operating leverage in this business is about to kick, that's the time for these companies to go for IPO. Because the underlying benefit of tech companies is that they have very high degree of operating leverage, and that helps them eventually. This business is generating much higher EBITDA and profitability.
You know, when it comes to valuation, and I'm sure that it's been a constant conversation right now with the number of unicorns, everyone being born. But, you know, it is a known fact that, you know, valuations in the private market is very different from, differ between profit-making companies and loss-making tech companies. Now, historically, when you look at loss-making startups, they garner better valuation in a private market, when you look at future value creation that they have, or future plans that they have, path to profitability, but what happens when these estimates are missed? How does that affect your valuation? And especially when they are in that cusp, or in that pivotal moment of touching and going IPO in that sense.
Yeah, yeah. So we haven't had any experience of that sort, because if you look at our portfolio, companies are growing anywhere from 40% CAGR on the lower end to almost 350, 400% kind of CAGR, right? And by the way, we have defined this entire tech investing by different stages. So we prioritize profitability over growth, or growth over profitability, depending on the stage of these companies. If the company is more of a late stage, 4 years away from IPO, we as an investor actually urge these companies to focus more on the growth parameters, right? Because the reason why tech companies are valuable is the underlying growth, right? And we don't get this kind of growth in the listed space. So we are inherently a growth investor, but the mindset is that they have to be sustainable. So, but as these companies are coming closer to the IPO, we are okay with businesses where the growth is tapering down, but the profitability has to start kicking in, right? And frankly, if you look at the overall stage, the entire stage, some of these companies, Indian companies are, the underlying growth is phenomenally high, because you not even scratch the surface. Just even the listed companies, right? Let's say Policy Bazaar, the overall insurance return in India is just about $125 billion. And the online penetration is not even 1.5%, right? Or if you look at beauty and personal care, again, like just 5 to 6% of the overall beauty and personal care has been kind of penetrated, right? So or let's say the food delivery space, it just has 25 million kind of user base. So the legroom for growth is fairly high. And in fact, if you look at the interesting slide I saw earlier, right? Like companies like DoorDash and all, they've shown tapering growth, but when you look at some of our underlying portfolio companies like Swiggy, Zomato and all, the underlying growth continues to be pretty formidable. And they're all well-funded. They're well-funded for several years. They're sitting with almost, like Swiggy has almost $2 billion of cash reserves, and Zomato has almost $1.3 billion of cash reserves. So in a way, even if they tend to burn capital, they'll have a good visibility of next 3 to 4 years. By the time they can turn profitable.
Right. When you come at tech businesses, there's a very interesting point you put in that, tech businesses, the whole idea is the kind of growth they have, the kind of business models they have, how they build new products. And if you look at it, many of them still keep piloting new business models, or whether it could be burning cash, that's debatable, but they do pilot new business models, and, and then they shut those down. Does this impact their valuation or their view in IPOs? How does that impact happen? Or is it something that is expected now out of tech companies?
It's a very interesting one. And in fact, we are supporters of companies where they're trying to create option values by new businesses. And we have been beneficiaries of that also. There is massive value creation happening, right? Like, for example, when we backed Daily Hunt, it was largely a news aggregator platform. And it's only that post our investment, they actually focused on this short video platform, where today YourStory is one of the leading players in this entire short video platform, with almost closer to 170, 180 million users. And that's a mouse. And or for example, if you look at Swiggy, right, they've been able to create value via Instamart. So by nature, platforms, given that they're very well entrenched, well networked, they can actually make the same asset sweat with adjacencies. And and for us as a team, we have actually looked at companies where there could be a substantial option value, and this option value eventually helps us also identify some multi-baggers. It's not that every time it's going to result in some kind of great outcomes, but having said that, because they are platforms, because they already have the same set of user base, which can be, like, for example, Nike, right? They have now moved from personal care, and they're trying to seed the fashion segment as well. And because they are tech enabled, it's much more easier for platforms to add adjacencies, tech enabled platforms or tech enabled companies. And that is something which is difficult in the offline world, because offline world, you need a lot of other real estates to actually bring in this kind of option value. And that's where we see some of the tech companies are able to create enhanced value even at a higher valuations.
Right, right.
Yeah.
So on that note, I just wanted to understand, should private profit-making tech companies remain private in that sense? And what is the advantage of going public versus private? There's no clear answer to that because like, I know Zerodha has said that it will take time, or at least it will not go public soon. It's not never, but they don't have visibility of that. So I just want to get a sense from you on this perspective.
I think so. Zerodha is a pretty unique case. They haven't
Yeah.
taken funding from external investors. Hats off to what they've been able to achieve. But broadly, a lot of other companies, given that tech companies tend to burn a lot of capital in the initial phase, whether building networks or they're building the entire business model, they tend to need a lot of cash, and they are going to bring in investors, right? And real value creation and the real liquidity event only happens at the time of IPOs. So I would still say that the aspiration of every founder is that that eventually they see a successful listing, and this company sustains for a much longer term. So all these companies which are sustaining and who have raised multiple rounds of financing in the private space, the aspiration of all these founders is going to get listed in the public market. So that's when we are going to really see the true value of the asset, and markets will be able to actually appreciate the inherent value of this asset, right? And that's when you actually do that something, because the private market is still private market, right? And when you look at the listed space, the number of participants is way more than what you could have in the private market. So the real test of the entire thing is the eventual listing.
Yeah. No, but when you look at it, the PE market today still has a massive tailwind, and it still seems to be going to be hot at least for a year or two as the stock market's correct. So what is your view of it? Is it going to be like that, or is it going to shift? Do you see that shift happening? Where do you see it headed as a late stage investor?
I would like that the late stage space also cools off a bit. I'm happy that markets are seeing a correction, because that helps us to get a good entry point into some of the companies. But having said that, there is going to be a fair bit of lag between the listed and the unlisted space for two reasons. One is that a lot of these companies are now well funded, because over the last 18 months, I think so, almost many of these companies have at least had one round of fundraise, and some of them have almost 2 to 3 rounds of fundraise, right? So they're very well funded, and they are not in any hurry or desperation to go and raise capital at lower valuations, because they can just take the sweet time. And secondly, on the other side, what has happened is that there are several funds which probably didn't participate in the entire tech rally in a way in India, right? Because the beneficiaries largely have been the VC funds and likes of Sequoia and Axels and Matrix. And then on the other spectrum, there are large global tech funds, and these are come with a very strong tech mandate, because they've seen this thing playing out in the US or in the other markets, and they're trying to replicate that in India, right? But there are a lot of investors who have not really participated in that tech rally, and I think so. As we speak, more and more investors are getting excited about the tech space, and over the last 12 odd months, many of them have come with tech-only funds, large billion-dollar fund, tech-only funds. So the dry powder which is there to back some of these companies is very, very high. So I don't expect that we are going to see that kind of correction in the unlisted space. The listed space might be a bit more volatile, but the unlisted space is going to the good companies anyways. When the Fed rates go up, when the interest rate cycles go up, it's typically the challenger brands which get impacted, right? And if you look at some of those dominant players, they are always able to attract capital even in a difficult market. So in a way, some of the dominant players, and that's a theme we have had enough fun of backing the dominant player in the category. And what we believe is that the same set of assets will keep on attracting more and more new investors. And we have seen that some of the companies we came in a very short span of time have seen at least a couple of rounds of further up rounds, just because the same asset is so attractive and so differentiated that that investors would like to come and back the same asset. So in that sense, the lag is going to be there for some time.
Now, Chetan, I'm damn sure this is a one, and this is my last question for the evening. I just wanted, I'm sure there's a burning question that everyone have that is tuned into the this conversation. What's your conviction of the tech stock markets moving forward, and which one would you pick if you were given a choice?
Probably I can give you some guidance without picking specific names, because we are also interested in some of the listed companies, so that could be
right.
So probably there could be some bias there. I would say that some of the business models where, especially some of the winner takes all plays, where the inherent relationship between the stakeholders is far more symbiotic, right? Or let's say like food delivery as a space. The inherent, there are a lot of exclusivity and entry barriers, because at one end you have had restaurants which are locked in. At the other end, you're also trying to bring in convenience, and customers are seeing that they're actually started paying a delivery fee for it. And at the other spectrum, so there are the various stakeholders all are benefiting from this entire setup, because restaurants beyond a point, they can only take that much amount of business, and food delivery is helping them to build in far more throughput in the business, right? And at the same time, it's adding a lot of convenience to the customers. So this kind of businesses, and given the stage where we are today, right, these are going to see a good amount of growth going forward. People can debate about valuations and inherent unit economics, but I would bet more on some of those monopolies or duopolies business model, because eventually there's a reason these companies have survived, right? At one point, you had 6-7 players in this segment, so the best have survived, and they are going to have a good leeway of growth, and we are still very nascent in terms of the entire evolution. So my bet would be more on some of those business models which are very differentiated, where the competitive intensity is very low, and eventually they are creating a lot of value for the inherent stakeholders, and because of the symbiotic win-win, this company should do well in the longer run. So I would bet more on monopolies and duopolies within the entire tech space.
Great, thank you so much. Can we take some of these questions, or Samarth, is someone online? Because I'm done.
Hey, Sindhu. Actually, we are a little, short on time, and we have a session just after that.
Super. So I think I'm done. Thank you so much. Thank you, everyone.
Thank you so much, Chetan. Thank you so much, Sindhu, for this love.